There's a number that keeps showing up in social media business advice: $50,000. The claim is that once your revenue crosses 50,000, you need to form an LLC or switch to an S-corp. The IRS doesn't have a revenue threshold that triggers a required entity change. That's not how this works. The decision to move beyond a sole proprietorship isn't based on how much you make, it's based on how much you have to lose, how complex your operations have become, and whether you've built the discipline to maintain a more structured entity. And once you make that move, what actually changes and what doesn't is something most business owners get wrong. Today, we're covering two things. First, the actual signals that tell you the sole proprietorship isn't serving you anymore. Second, what a single member LLC really is, because the gap between what people think it does and what it actually does is where the most confusion lives. Welcome back. I'm Lauren Twitchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent. I've seen this from both directions. At the IRS, I saw sole proprietors who stayed in the default structure long past the point where their risk justified it. On the other side, I now see people jump into S-corp elections and multi-entity structures before they can keep a basic bank reconciliation current. Both of those are problems. One is understructured for the risk, the other is overstructured for the stage. Let's start with the signals that tells you it's time to consider a change. The first signal is risk exposure. Most people focus on income when they think about entity structure, but risk is the factor that should drive the liability protection decision. Consider two businesses. Business A is a marketing consultant working from home. Revenue is $150,000 a year. They give advice. They don't handle physical products. They don't have employees. Their professional risks exist, but it's relatively contained. Business B makes candles. Revenue is $20,000 a year. They sell a product that people light on fire inside their homes. If one of those candles causes property damage or an injury, the liability exposure is significant. Business B has a stronger case for forming an LLC than Business A, even though they're making a fraction of the revenue. The question isn't how much money you're making. The question is, if the business got sued tomorrow, what personal assets are exposed? If the answer includes your home, your car, or your savings, the default structure is leaving those unprotected. The second signal is when you start working with other people. The moment you go from doing everything yourself to hiring a contractor or bringing on an employee, the liability equation changes. You're potentially exposed to mistakes made by someone operating under your business name. An LLC creates a barrier there. Not absolute immunity, but a legal separation that matters if something goes wrong. The third signal is operational maturity. Operational maturity means you have systems in place. Your bookkeeping is current. Your bank accounts are reconciled. Your income and expenses are documented. This matters because moving to a more complex entity doesn't fix bad habits. It amplifies them. If you can't keep clean records as a sole proprietor, forming an LLC doesn't solve that problem. It adds a layer of compliance requirements on top of the mess you already have. Being tax ready at your current stage is a prerequisite for moving up, not a result of it. If your Schedule C records aren't clean, fix that first. Now, here's the part that surprises most people. When you form a single member LLC, your federal taxes don't change. You don't get a new deduction, you don't get a lower rate, you don't file a different return. You're still on Schedule C. You're still reporting income and expenses the same way you did before the LLC existed. The IRS calls a single member LLC a disregarded entity. That's the technical term. They look right through the LLC and tax the person behind it. For federal income tax purposes, it's as if the LLC doesn't exist. So if the tax treatment is identical, why form one? Because the LLC isn't a tax decision, it's a liability decision. What changes is the legal separation between the business and you personally. The LLC creates what's called the corporate veil, a legal barrier between the business's obligations and your personal assets. If the business is sued or can't pay a debt, that barrier is what keeps the claim on the business side. But that barrier only holds if you maintain it. If you form an LLC and then continue to run everything through your personal check account, skip the operating agreement, and treat the business bank account like it's an extension of your personal piggy bank, a court can disregard that LLC the same way the IRS does. That's piercing the corporate veil. The protection you paid for doesn't actually protect you because you didn't follow through on the requirements. When I was at the IRS, I saw this confusion constantly. Business owners would form an LLC and then try to file a corporate return or a partnership return because they thought that the letters LLC changed their tax classification. It doesn't. Unless you explicitly make an election like an S-corp election, which we'll cover later this season, your single member LLC is taxed exactly like a sole proprietorship. Same form, same rules, same self-employment tax. An LLC is a creation of state law, not federal tax law. When you file your articles of organization, you are talking to your state. You told the state you wanted to be recognized as a separate legal entity, and the state said fine. But the IRS doesn't have a tax classification called LLC. There's no box on a federal return that says, I'm an LLC, tax me differently. So, what does maintaining the LLC's protection actually look like in practice? First, get an EIN if you don't already have one. An employer identification number is the tax ID for your business. Even if you have no employees, the EIN gives the LLC its own identity for banking and tax purposes. You need it to open a business bank account, and the business bank account is the foundation of the entire separation. Once you have an EIN and the bank account, every business transaction goes through that account. Revenue comes in through the business account. Business expenses go out through the business account. When you take money out for personal use, it's documented as an owner's draw. Second, have an operating agreement. Even though you're the only member, the operating agreement establishes how the business operates, how decisions are made, how profits are distributed, what happens if the business is dissolved. If your LLC is ever challenged in court, the operating agreement demonstrates you treated the entity as a real organized business. Third, sign contracts in the name of the LLC. When you enter into agreements with clients, vendors, or contractors, the LLC is the party to the contract, not you personally. If you're signing everything in your personal name, you're undermining the separation. These aren't one-time tasks. They're ongoing discipline. The filing fee gets you the legal structure. The daily behavior is what keeps it intact. Before you file anything with your state, consider the cost. Most states charge a filing fee to form an LLC. Many require an annual report and an annual fee. Your bookkeeping has to be tighter because you're maintaining a separate entity. None of that is prohibitive, but it's real, and you need to account for it. The other trap is what I'll call the certificate on the wall problem. Someone forms the LLC, gets the paperwork, and then changes nothing about how they actually operate. Same bank account, same commingled transactions, no operating agreement. They have the legal structure on paper, but their behavior doesn't match. And if that entity is ever tested, behavior is what matters. The entity is only as strong as the discipline behind it. If you're going to form an LLC, commit to operating it like a separate entity. If you're not ready for that, the sole proprietorship is a perfectly legitimate place to stay until you are. Here's the bottom line. Moving beyond a sole proprietorship is a strategic decision based on your stage. You move when the risk you're carrying exceeds the simplicity you're benefiting from. You move when your operations have matured enough to support the additional requirements. And you move when you're confident that your record-keeping discipline will hold up at the next level. If you have personal assets you're not willing to lose and your business carries liability exposure, it's worth evaluating whether the default structure is still appropriate. Next week, LLC compliance, the ongoing requirement that keeps the entity valid. Operating agreements, state filings, financial separation, and specific things LLC owners forget that cost them the protection they paid for. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.